In the UK, we've got two very tax efficient ways to save. One is an ISA, which is an individual savings account, and the other is a SIPP, a self-invested personal pension. Both of them are quite different in terms of when they offer you the tax benefits and whether that comes out of your gross income or your net income. So let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. The purpose of an ISA and a SIPP is to avoid two types of tax. The first one is capital gains tax. If you buy low and sell high at a profit, then you have to pay tax on that gain, but not if it's held inside an ISA or a SIPP. And if you own some shares or funds, they'll pay you a dividend income. And again, if that's not held inside a tax-efficient wrapper, you'll have to pay income tax. There's a threshold for capital gains tax and income tax. So if you have a low income, then you could avoid paying these without the benefit of a tax wrapper. The primary difference between an ISA and a SIPP is given away by their name, because an ISA is just a type of savings account. It's your money and you can take it out anytime you like, whereas a SIPP is a pension, which means you can't access it until you retire. However, both of them have a similarity, which is that they protect your money from the taxman. And another way to think of them is as a tax invisibility cloak. Any capital which is inside the cloak won't be liable for either income tax or capital gains tax. One of the ways SIPPs and ISAs vary is the amount of money that you can put in, but also the type of savings you make in tax. One of the great benefits of a SIPP is that the taxman contributes some of the money for you. So let's say you're taxed at the 20% rate. That means that the money you earn between around £12,000 and £46,000 will be taxed at the 20% rate. But your SIPP contribution comes out of your pre-tax income. And that means that if you invest £100 in your SIPP, effectively you only contribute £80 of that £100. The rest of it will be contributed by the taxman. That means your savings get an instant boost. And that's not true of an ISA, where your contribution comes after you've paid tax. And the more tax you pay, the greater the benefit. So for higher rate taxpayers who are paying 40% on their income, the taxman will contribute £40 for every £100 contribution. Of course, there are limits to this. You can only contribute 100% of your annual earnings. And there's also a cap of £40,000 a year. And over your whole lifetime, there's a 1.03 million cap, which is called your lifetime allowance. If you have a really high salary, which exceeds 150k, then your allowance gets whittled down by £1 for every £2 you're above 150k, such that an adjusted salary of £210,000 would leave you with an allowance of only £10,000. The stuff that you can put into a SIPP is very broad, and it's roughly the same as the things you could put into a stocks and shares ISA. That would include exchange-traded funds, government bonds, corporate bonds, and unit trusts and investment trusts, and also some more esoteric products. Let's compare that with putting money into an ISA. The limit for 2018-2019 is £20,000, and also the types of ISA are much more diverse. There are 4 at the moment, and you can split your 20k contribution amongst all 4 of those different types of ISA. The tax year for the ISA contribution runs from 6th of April to 5th of April, and you can only put £4,000 into a lifetime ISA for each tax year. Different types of ISA also come with different age limits, with a cash ISA starting at 16 years of age and with a lifetime ISA capped at 40 years. So let's take a hypothetical example, and no, this isn't a recommendation, it's for illustrative purposes only. You could put £15,000 into a stocks and shares ISA from Vanguard, £2,000 into a cash ISA with Nationwide, £2,000 into a rate setter innovative finance ISA, and £1,000 into a Nutmeg lifetime ISA. And perhaps you have a child for whom you could put £4,260 into a junior ISA with Orbis. SIPPs and ISAs also vary in the way you take your money out. Let's start with SIPPs. During your working career, you're paid a gross salary, and gross is before you pay tax. You make your SIPP contribution out of that gross salary, so in effect you haven't paid tax on that money. and then whatever's left of your salary is what you pay tax on. And you get the most out of a SIPP if during your working career you pay a relatively high rate of tax. But you will have to pay tax on the income that you take out of a SIPP, which is sort of fair because you didn't pay on the way in. But when you retire, your salary will probably be lower than it was when you were working. So this isn't so bad because at that point you'll be paying a lower rate of tax. And because it's a pension, you can't touch the money until you reach the age of 55. All you can do is put money into a SIPP, and it's locked so you can't touch it. Once you reach 55, you might choose to start taking your money out, although you'd probably be better off leaving it in as long as possible. And ideally, it wouldn't run out before you die. Once you decide to start taking money out of a SIPP, you can either take it as a cash lump sum, you can purchase an annuity, which is a lifetime income which is guaranteed, or you can do something called a flexi access drawdown, where the money remains invested, but you can take a certain amount out each year, and the amount you take out could be variable. If the amount you take out of your pension is less than your personal allowance, then you won't pay any tax at all. And if you take a lump sum, then 25% of that lump sum would be completely tax-free, and it won't affect your personal allowance. As I say, it's probably best to keep your pot untouched as long as possible, and while you do that, you won't have to pay any tax. Any of the other options would incur that 25% tax-free lump sum, and then you pay tax on the remaining 75%. For the annuity and the adjustable income products, you pay tax on the income they generate. If you take money out of an ISA, it's much more flexible because it is just a savings product. For example, you could accumulate it until you die. Or more likely, you'll just put some money into it every year, up to a cap of your ISA allowance, and that might look something like this staircase, and then at a certain age you'll start to take money out. And when you do, you don't have to pay any tax on it again, because remember, for the ISA, you've already paid tax. All you're doing is moving your own money from one account to another. Or perhaps you'll do it in two stages, an accumulation phase, then some period of time when you take money out, then start to build up the savings again, and then take the money out. Basically, you can do it any way you like. But if you don't use your ISA limit for 1 year, you lose it. And usually money that you take out of an ISA loses its tax benefits. An exception to this is a lifetime ISA, which you can only use for specific life events, which includes buying your first home or retirement. And the age limit for retirement is 60 for a lifetime ISA. Another exception is if you're terminally ill, with a life expectancy of 12 months or less. But be really careful. If you take your money out without meeting any of those criteria, you get a huge charge of 25%. So whatever you do, don't treat your lifetime ISA as a short-term savings product. It's called lifetime for a reason. And although it's not pleasant, it helps to think about what happens if you die. And here, ISAs and SIPPs are quite different. What's nice about a SIPP is that if you die before the age of 75, the people who inherit that money won't have to pay tax on that lump sum. If you die after the age of 75, then the beneficiaries will have to pay income tax on any lump sum that they get. For an ISA, it's slightly different. The ISA gets closed down either by the executor or once administration of your estate is complete. If neither of those happens, then the ISA gets shut down 3 years and 1 day after you die. And any money generated by selling the assets inside the ISA just get mixed in with the rest of your estate. So here there's no benefit of dying before you reach the age of 75. Overall then, the SIPP probably gives you the greater tax benefit over your entire lifetime, particularly if you're a higher rate taxpayer while you're working and you take a smaller income when you retire. But it comes with that inflexibility, whereas the ISA, you can access your money at any time. And it's not either or, you can have both. So I hope you found that useful. Many of you tell us that you do find these videos useful. If it was useful, then please consider supporting us. It's only $5 a month and you get loads of stuff for that $5. You get access to our Slack channel, so you can ask us questions anytime. And you get access to our live Q&A session on a Sunday evening. And you can also get exclusive content. And if you support us at the $10 a month level, like Liam, Kate, Robert and Ian, then you also get bespoke analysis of your portfolio. And if you support us at the $15 level, like Chris, Vivek, Luis, Craig, Andrew and Kishore, then you get a one-to-one power hour with me when you can discuss anything you like about finance or investment. And remember, I don't offer advice, it's only education. And as always, thank you for listening.